Picture this: your money quietly growing in the background while you focus on living your life, traveling, building your career, spending time with family. That's the promise of smart investing. But if you're just starting out, it can feel overwhelming, especially when the financial world throws around terms like index funds and ETFs, as if everyone already knows exactly what they mean. So which is truly better for a beginner looking to grow wealth with minimal stress? In this video, we're breaking down index funds, viz. ETFs, in simple, no jargon language. So by the end, you'll know exactly which option makes sense for your goals. And hey, while you're here, go ahead and hit that subscribe button so you never miss more guides that simplify investing. And drop a comment sharing what you're most excited, or even nervous, about when it comes to putting your money into the market. I promise, this will all start to feel a lot clearer. 5. The big picture. What's the difference anyway? Imagine two travelers standing at the start of a journey. They both want to explore the vast land of investing, but they're cautious. They don't want to bet everything on one golden ticket that might vanish tomorrow. They crave the safety of traveling with a crowd. Enter index funds and ETFs, two of the safest caravans on this financial road. Both are like giant treasure chests, filled with hundreds, even thousands, of tiny stakes in different companies. Instead of betting on just Apple or Tesla, you're owning a tiny slice of all the giants, the upstarts, and everyone in between. But here's where these travelers' paths fork. An index fund is more like joining a scheduled tour group. Once a day at sunset, everyone in the caravan decides what your share is worth. You can buy in or cash out, but only at that single daily price, set when markets close. You travel at a steady, predictable pace. An ETF, on the other hand, is like hopping on an open-air bus that stops at every corner. You can jump on or off any time during the day. The ticket price changes minute by minute, depending on how many people are buying or selling. Both vehicles take you through the same landscape, the same rolling hills of the S&P 500 or the tech-rich lands of the NASDAQ. But the way you travel, the flexibility you have, and the small costs along the way vary. Understanding these subtleties can mean the difference between a journey that matches your temperament or one that keeps you nervously checking your phone. 4. Liquidity and trading. The power of real-time control. Let's drop into a vivid scenario. Imagine it's a bustling weekday morning. News breaks across every screen. Inflation numbers just came in hotter than expected. Markets are sliding fast. If you own an ETF, you can pull out your phone, place a sell order at 10:27 a.m., and the trade executes almost instantly. Or maybe you're feeling bold. You decide to buy more shares while the market's dipping, hoping for a rebound. Your order fills within seconds. The flexibility is total. Index funds work differently. Even if you place an order to buy or sell at 10:27 a.m., it won't actually process until the market closes at 4 p.m. By then, prices might have plummeted further or snapped back up, entirely changing your outcome. It's like booking a hotel room, but only finding out the rate after you committed to pay. This daily pricing mechanism means index funds insulate you from acting on panic. You're forced to ride out day-to-day drama, which studies show can actually lead to better long-term behavior. But if you want precision control, to buy exactly at a dip or sell at a surge, ETFs give you that minute-by-minute grip. For some beginners, this power is comforting. For others, it's a temptation they'd rather not have. Think carefully about your own emotions. Are you a person who might nervously check the ticker every hour, or would you rather be shielded from yourself? 3. Minimums and accessibility, where ETFs shine for the little guy. Picture yourself as a brand new investor. Maybe you're 22, just started a job, and you've managed to save up $100. Itching to invest, you explore index funds, but quickly you bump into an imposing gate. Many top-tier index mutual funds still demand minimums like $1,000, $3,000, or more just to get started. Vanguard's legendary VFIX, one of the purest S&P 500 index funds, still has a $3,000 entry fee. That's like wanting to take a short stroll through a beautiful garden, only to find you need to buy a season pass. ETFs smash this barrier to pieces. You can buy a single share of an ETF for whatever it costs. Maybe $90 for VOO, the ETF version of that same Vanguard S&P 500 index. And with fractional shares, many brokers let you start with $5 or $10, owning a precise sliver of the ETF. It means your very first paycheck could start working for you immediately. This lowers the psychological hurdle too. You don't need to wait months or years to accumulate a big lump sum. You can start your investing habit instantly, even if it's tiny. Over time, that habit is far more powerful than waiting for a someday that might never come. For absolute beginners, this accessibility makes ETFs one of the simplest on-ramps into the world of wealth building. 2. Costs, fees, and taxes. The hidden drips on your returns. Zoom in on the fine print. That microscopic text most people skip. Over decades, these tiny details can quietly siphon thousands from your future self. Expense ratios are the annual fees the fund charges to operate. Paying for portfolio managers, administrative costs, even legal compliance. Fortunately, both index funds and ETFs are ruthlessly cheap these days. You'll often see identical costs. Vanguard's famous S&P 500 index fund might charge 0.04% annually, meaning you pay $4 per year on every $10,000 invested. Its ETF twin, practically the same. But ETFs often sneak ahead on other cost fronts. Index mutual funds might slap you with short-term redemption fees, punishing you if you sell within 60 days. Some older funds still carry transaction fees or minimum purchase increments, ETFs, almost universally free to buy and sell, especially with the wave of commission-free trading apps. Taxes add another layer. Because ETFs trade between investors on the open market, they rarely have to sell underlying stocks. That means fewer capital gains distributions, sparing you surprise tax bills each December. Index mutual funds, by contrast, sometimes need to sell holdings to raise cash when lots of people redeem shares, triggering taxable events even if you didn't sell anything yourself. In a tax-advantaged account like a Roth IRA or 401, these differences fade. You're shielded from capital gains anyway. But in a regular brokerage, that slight edge often tilts to ETFs. 1. Personality and discipline. The honest beginner's fork in the road. Now we arrive at the heart of it. Strip away the mechanics, the fees, the trading hours. And the choice between index funds and ETFs often boils down to who you are. Imagine two beginner investors again. Investor A gets anxious easily. They peek at their portfolio 3 times a day. They have to resist selling at every scary headline. For them, an index fund is a brilliant behavioral shield. The once-a-day pricing means they can't panic sell at 11:07 a.m. when markets dip on rumor. They can set up auto-investing, add a chunk from each paycheck, and forget about it. This disciplined routine is what builds real wealth. Slow, boring, relentless compounding. Investor B is curious, maybe a bit more hands-on. They like seeing live prices, appreciate being able to buy dips or set automated limit orders. They're not planning to day trade, but they do want the flexibility to adjust on the fly. For them, an ETF is a perfect companion. It still gives broad, diversified market exposure, but with a trader's toolkit of precision and timing. It's like choosing between a cruise ship and a speedboat. The cruise ship, index fund, moves steadily. You can't steer minute by minute, but its calm almost always gets you there. The speedboat, ETF, lets you dart around, drop anchor, or race ahead when you see an opportunity. The truth? Over 30 years, the returns between a top-tier index fund and its ETF twin are nearly identical. The real danger isn't picking the wrong vehicle. It's never boarding either one. The difference maker is you, your habits, your emotions, your ability to stick with the plan when waves hit. Both index funds and ETFs give you the single greatest investing superpower: broad diversification at ultra-low cost, harnessing decades of market growth without guessing which stock will win. Whether you sail there in the calm steadiness of an index mutual fund or zip along with the intraday flexibility of an ETF, you're already winning compared to most people who never invest at all. In the end, the best choice isn't about markets. It's about understanding yourself. That's the real first step to becoming a confident investor. So after hearing the pros and cons, which one feels like the best fit for you? Index funds or ETFs? I'd love to hear your thoughts in the comments. If this video helped clear up the fog or gave you the confidence to take that first investing step, give it a big thumbs up, hit subscribe, and tap the bell so you're always first to catch more strategies that help your money grow. Thanks so much for spending a few minutes with me today. Here's to building a future that gives you more freedom and peace of mind. I'll see you in the next one.